Many retirees, regardless of their wealth, are entitled to federal tax credits, pension income splitting, and property tax deferrals. It is time to stop overpaying. Whether your entire income is an OAS and CPP check, or, maybe you've got a solid workplace pension, a healthy RRIF, and a house in Toronto or Vancouver that has literally tripled in value, there is real money on this list with your name on it. The honest truth? Canadian seniors at every income level are overpaying common bills simply because they just assume the relief is meant for someone else. And let's be real, the organizations collecting this money, they have a direct incentive to keep quiet. Your municipality is definitely not going to call you up to defer your taxes, and the CRA isn't mailing a surprise check for a credit you forgot to claim. Taking action on what you don't actually have to pay, that is entirely up to you. All right, let's dive into bill number 1, the invisible federal income tax drain. I really need you to hear this one, because for millions of Canadian seniors, the absolutely correct amount of tax you owe going forward is exactly 0. Yet so many people are still paying it out of pure habit. You don't give anything up to get these credits. You don't even have to itemize. They literally just stack right on top of each other just by virtue of your age. Step 1 is the basic personal amount. That's a tax-free chunk of income around $15,000 to $16,000 that every single Canadian gets. But the moment you turn 65, you get to stack step 2 right on top of it, the age amount, which sits at $9,208 for the 2025 tax year. Then comes step 3, the pension credit, which applies to the first $2,000 of eligible pension income. Oh, and keep in mind, almost every province stacks their own age and pension credits right on top of these federal ones. It's like a giant puzzle where every piece saves your money. We need to bust a major myth right now. People always assume these breaks are only for one specific wealth bracket. They're absolutely not. Look, if you're a modest income retiree pulling in maybe $22,000 or $23,000 between OAS and CPP, stacking these credits very likely pushes your federal tax bill completely to 0. But look at the middle-class retiree. You get to retain the full age amount right up until your net income reaches about $45,500. And honestly, it doesn't fully disappear until you hit around $105,000. So everyone gets real value here. But here's the catch, and it's the one that costs people the most. If you don't file a tax return, you don't get any of it. Filing isn't just about paying a bill. It is literally the door you have to walk through to claim your money. Moving right along to bill number 2, benefit check withholdings. So a lot of seniors voluntarily ask the government to hold back extra tax from every monthly CPP, OAS, or pension check, just to be safe. They're basically waiting for a big lump refund the next spring. But doing that, you're basically handing Ottawa a massive interest-free loan all year long. You really need to right-size that withholding so it matches what you actually owe. Plus, I want you to look at this exact number, $93,500. That is the net income threshold for the 2025 tax year where the government starts coming for your benefits. And that brings us to the OAS clawback, or as it's officially known, the Old Age Security Recovery Tax. If your net income crosses that threshold we just mentioned, the government quietly takes back 15 cents of your OAS for every single dollar you earn above that line. It's just shaved right off your check before it even lands in your bank account. By the time you're up around $150,000, your entire OAS could be gone. The real trap here, though, a single one-off big RRIF withdrawal or maybe a capital gain can push you over that line for just 1 year. That triggers a clawback on money you aren't even living on day to day. It's wild. Okay, let's talk about bill number 3, property tax deferrals. Now, this is the bill that genuinely makes people angry once they finally find out about it, mainly because your municipality will never, ever proactively chase you down to offer this relief. I mean, every dollar you defer is a dollar of revenue they don't collect right away. Across the country, there are basically 2 distinct kinds of senior property relief. On one side, we have income-based deferrals. Places like Ontario offer targeted relief for low-income seniors, like those receiving the Guaranteed Income Supplement, which sometimes allows you to defer or even wipe out the bill entirely. But on the other side, we have age-based deferrals, and this is the one comfortable retirees always assume they're far too well off to qualify for. Provinces like British Columbia and Alberta actually offer equity-based deferments for homeowners 55 and over, regardless of having a high income. This lets comfortable seniors keep cash working in their own pockets, having the province pay the municipality on their behalf, and you just repay it with interest when the home is eventually sold. It's a real game changer. But listen, action is absolutely required here. These programs have hard deadlines, often early in the year, and they demand that you apply directly. So, Pick up the phone, call your municipality, or go search your city's website for senior property tax deferrals. Ask them exactly what relief exists, and specifically ask which ones are based on age with no income test. Next up is Bill number 4, pension income splitting. This is a strategy that couples miss all the time, literally leaving thousands of dollars sitting on the table annually, simply because they file as 2 separate islands instead of acting as a team. The moment you utilize Form T1032, you trigger multiple cascading financial wins. If you're 65 or older, you can shift up to 50% of your eligible pension income over onto your spouse's return, just for tax purposes. Since Canada tax higher incomes at higher rates, shifting this income to a lower earning spouse instantly drops the household's total tax rate. But wait, there are 2 more massive wins here. Moving that income off your return drops your own net income, right? Which can pull a higher earner right back under that OAS clawback threshold we talked about, rescuing your benefits. And it unlocks your spouse's $2,000 pension credit, so the household gets to claim it twice. Just remember, your tax software is not going to do this automatically unless you explicitly tell it to. Let's look at Bill number 5, unnecessary tax prep fees. It is so incredibly frustrating to watch seniors walk into a storefront tax shop and just hand over hundreds of dollars for simple data entry just so they can deal with all their other bills. Instead, you really need to know about the CVITP. That's the Community Volunteer Income Tax Program. Run by the CRA and community organizations right across the country, this program prepares returns for modest income seniors completely free of charge. You'll find these clinics hosted at local libraries, legions, and senior centers. And get this, the modest income guidelines actually reach well into the middle class. If your return is just 2 pension slips, your OAS, your CPP, and maybe a simple investment statement, please do not assume you have to hand someone a huge fee. Now, obviously, if your situation is genuinely complex with businesses or rental properties, for sure, pay a professional. But for simple returns, this free help is just waiting for you. All right, let's get into some bonus moves. 3 wealth strategies. Let's pivot for a second to something specifically for the retiree who has built up equity, investments, or a healthy RRIF. These wealth strategies confront common financial mistakes, and honestly, they can be worth more than everything else combined. Take a home sale, for example. Say you bought a place for $60,000 decades ago. It's now worth $700,000, and you're staying in a house that's way too big just because you fear massive taxes on all that equity. Well, because of the principal residence exemption, for the years it was your main home, that enormous gain is generally completely tax-free. Then let's look at low-year drawdowns. A lot of retirees stop working and just leave their RRSPs totally untouched until mandatory RRIF minimums kick in. That is a massive missed opportunity. There's this golden window where your income is the lowest it will ever be. You want to purposely draw down early in those low-income years, paying very little tax now to avoid future, forced massive withdrawals that could drag you into a higher tax bracket and straight into an OAS clawback. Our third bonus strategy focuses on charitable giving. If you give to a hospital or a food bank and you hold investments that have gone up in value, whatever you do, do not sell them first. Selling triggers a capital gains tax on the investment right before you give. Instead, donate the appreciated securities directly to the charity. Doing this entirely eliminates the capital gains tax, and you still secure the exact same full charitable donation tax credit. The charity receives the exact same amount, and you completely wipe out a tax bill you would have otherwise paid. It is a brilliant move. So, let's move to the most important takeaway of all. Being eligible for a tax break and actually getting it are 2 completely different things. The whole system is basically built so the money stays exactly where it is, unless you actively stand up and claim it. Every single exemption and strategy we've looked at today is real, but not a single one of them is automatic. Knowing the rule exists and knowing that it applies to you no matter where you sit financially, that is the entire game. People so often assume the relief must be meant for someone else, so they just keep paying. Don't be one of them. So I'll leave you with this final thought to consider. Are you or a loved one paying a bill you really don't have to?